Good morning. I'm Dr. Wilson Pearl, Associate Professor, Department of Corporate Secretaryship of KCS Kasnada College of Arts and Science. We are going to see what is the firm underwriting. The firm underwriting is the format I given you here. As usual, we'll start with the gross liability minus minus marked application, then minus firm underwriting, then unmarked. The remainder will be net liability. Then you'll add back your firm underwriting, which you deducted in the second stage. Okay. The final answer will be called as net liability. This is a format which is named as when the firm underwriting is treated as marked application. When the firm underwriting is treated as marked application, or we can say that when the firm underwriting is given credit to the individual underwriters. Both means one and the same. Okay. When it is given in that way, you have to follow this format. Okay. Now we'll go to the next slide. Next method, where the firm will be treated the firm underwriting will be treated as unmarked application. Next slide. Now here, when the firm underwriting is treated as unmarked application, in that case the format is as follows: the gross liability XYZ, the marked application minus. Then after minusing the marked application, you will minus your unmarked, not your firm underwriting, which means your firm underwriting put together with your unmarked, you will minus both together as unmarked. Okay. After minusing unmarked, the remainder will be a net liability. Whenever in between when you get a surplus, you have to share that between the remaining underwriters. The same logic that holds good for all the sums. Okay, so that is there till the end. Okay, the same logic from the beginning. Whenever you come across a surplus for any underwriter, the surplus will be shared by the remaining underwriters in the gross liability ratio. That will be holding good for all the sums. Okay, not only anything. Okay, now. So these are the format of your firm underwriting treated as unmarked application. Now we'll go to the next slide. We'll see one sum now. Now we'll see the sum. Fast Forward Limited made an issue of 60,000 shares which were underwritten by X and Y and Z as follows. Okay. Now X 30,000 shares, Y 18,000 shares, Z 12,000 shares. In addition, there is a firm underwriting as follows: X 3,000 shares, Y 1,500 shares, Z 4,500 shares. Okay. The total subscription including firm underwriting were 45,600 shares. The following marked application form were included in the subscription, which means out of this 45,600, the following the marked application was there: X 9,000 shares, Y 3,500 shares, Z 5,600 shares. Show the allocation of liabilities of each underwriter if the firm underwriting is treated as marked application, if the firm underwriting is treated as unmarked application. So which means the same sum will be done in two ways: when the firm underwriting is treated as unmarked. Okay, now we'll see the same sum when the firm underwriting is treated as marked application. Now I've written the gross liability over there minus marked application, then minus my firm underwriting. Okay, I'll then after minusing my firm underwriting, I'll minus my unmarked application. After minusing my unmarked application, we'll add back the firm underwriting, whichever I minus earlier, I'll add it back so that I'll get the total liability of underwriter. That is what is done here. You can see that. Okay. Any doubt? Now we'll go to the next slide where the firm underwriting is treated as unmarked application. Now here the same sum, the firm underwriting is treated as unmarked application. Now the gross liability is written there, then marked application X 9,000, 13,500 and 5,100. The remainder will be the, as usual, the liability. Now next, after the minusing marked application, you will minus your unmarked application. Here the unmarked means including your firm underwriting. Both will be added together and we'll minus it here. So now in this case I get a surplus for X or Y. For Y I get a surplus of 900 shares. So this surplus will be shared between A and C in the gross liability ratio. Okay, as usual. The remainder will be your net liability. After finding the net liability, you will add back your firm underwriting. Okay, so that after adding a firm underwriting, that will be a real net liability of the total net liability of the underwriter. Okay, so that is the logic here for firm underwriting. Any doubt? No. That's it. Now, these are sums where you can work out the for the same firm underwriting sums. Okay, next. Now let us see some journal entries. Suppose if the problem asks you to prepare a journal entry in the books of the company, there are 4 entries which has to be written in the books of the company. The first entry will be bank to share application. Okay, for the share subscribed by the public. Then second entry will be the liability for the liability of the underwriter, which you will found in the previous sum. The last line answer will be taken as a underwriting liability. For that you will write an entry here. Then underwriting commission, which is to be paid by the company to the underwriter, the due entry. Then the net amount to be received or paid by the company to the underwriter. That is the last entry, bank to underwriter, which means the company will receive money from the underwriter. If it is company is going to pay, then underwriter to bank, the reverse entry. Next, there are some entries which will be posted in the books of underwriter also. That we will see in the next slide. Now, so these are the entry you draw in the books of underwriter. The first entry for the shares taken by the underwriter, taken as an underwriter obligation, which means the gross liability. Share in a X company to company's account. Then for commission receivable, okay, the underwriter will receive the commission. No? For that, the commission will be the credit. Therefore, the company's account data to underwriting commission. Then for payment of cash in settlement, the company has to pay or the company will receive the whatever it is. So in this case here, the company has to be paid. The company has to be settled. Then company account data to bank. Suppose if you are going to receive from the company, then bank account data to company it will be. Then if there is any decline in the market value, for example, if the underwriter has taken shares for his own purpose also, then later on particular day the shares will be sold in the market. If at the time of sale of the shares, the share price may be higher or the share price may be lower. So if it is a lower, it is a loss for the company, loss for the underwriter. Therefore, in that case, the loss will be written as P&L account data to shares or debentures. If it is a profit, it will be shares or debentures to P&L. Okay, so that's it. Now we'll see a simple sum now. The next slide. Now, the company issues 10,000 shares rupees 10 each as per at par. Okay, the issue was underwritten by K and Co for a maximum commission permitted by the law. The public applied for and received 8,000 shares. Give journal entries in the books of the company and also prepare balance sheet. Okay, they didn't ask for the journal entry in the books of the underwriter. A simple one. The first case, I'm going to find what is the net liability of underwriter. So what will be the net liability of underwriter? Here it is only one underwriter, K and Co, which means 10,000 is the gross liability. Out of 10,000, 8,000 shares are received by the public. So remaining will be 2,000. So 2,000 will be net liability. Okay. First, the entry will be only for the general public first. 8,000 shares. Therefore, 8,000 into 10, 80,000 rupees. So bank to share capital for the share subscribed by the public, the first entry. Then the second entry will be the underwriter's liability. Here the 2,000 shares is the liability of underwriter. So 2,000 into 10 will give me total value 20,000. Okay. Then next entry for underwriting commission payable by the company. In that case, underwriting commission to K and Co. The commission is normally will be at 2.5% on the nominal value. Nominal value is the total gross liability. Okay. Here in this case, 10,000 into 10 will give me 1 lakh. That will be the nominal capital. Out of 1 lakh, they have to pay 2.5% as commission for underwriting. So that is the entry here. Underwriting commission account data to K and Co 2,500. Then net amount. The underwriter has to pay 20,000 as a net liability. The company has to pay 2,500 as a commission to the underwriter. So what is the net amount to be collected by the company? Okay, the underwriter has to pay 20,000 to the company. The company has to pay to the underwriter 2,500 rupees. So net amount will be 17,500. That will be bank account letter to K&Co. Okay, so this is all about your journal entry. The journal entry holds good for any method. For if it is a firm underwriting or whole underwriting or partial underwriting, everything the same entries will be there. There's no difference in the entry. Then you have to prepare the balance sheet. The next slide we'll see the balance sheet. Here, the share capital which is issued by the company is 1 lakh. It is written there. Then reserve surplus, non-current liability, current liability. Even though you don't have anything, you have to write the format first. Okay, then on the asset side, non-current assets, that is fixed assets, or the next one, current asset. Current asset, cash in hand. What is the cash collected? 97,500. Then under the other assets, we are going to write 2,500 is a commission. The commission to be paid, yet to be paid. Therefore, it is a loss. You will return the asset side under the heading other current assets, 2,500. Okay, so therefore the balance sheet will tally both sides. Okay, that's it. It's all about the underwriting. Thank you. We'll see in the next class.